off?
I have a short one. I've
Okay.
got a colleague friend who's got about a $5 million gain on his home. He's owned for 20 years. He has leased it over the years, and he's staring at least $1 million tax bill because he's not planning to 1031 it. So
Right.
how do we avoid
Okay.
the tax or kick it down the road or something?
Okay. Okay. Well, let's avoid answering it just now,
Uh-huh.
just so we get the questions on the board.
Yeah. And
Anyone else?
unfortunately, I've got to leave in half an hour. So if I,
Well, this
yeah,
is being recorded, so
yeah.
you get the answer. Anyone else with a question to give a flavor for what you're trying to learn about?
Mark, I wanted to share, I'm actually going to share it in the chat. We put together a client alert just a couple of days ago on one big, beautiful bill. And so I just shared it for everyone, and you could take a look and see what's in there.
And thank you, Olga. And Greg, you've got something similar. Are you gonna present it first?
I'm just gonna talk through it. I appreciate all the big firms like Winston and Strong. I've probably read in the last 5 days about 20 of those summaries from law firms and accounting firms. I'm missing Deloitte's webcast right now. So there's a lot to unpack here. I think we're gonna try to hit the highlights here. 1,082 page bill of small print text. The only good news is only 500 and something pages of it relate to tax. So we're still diving through this. So apologies on not having any answers on specific questions. I'm going to try to hit most of the highlights because there is a lot to unpack here. And I'm not even going to touch on any of the international tax provisions. So if anybody was hoping to hear a lot about that, this is not the forum for that because I'm not an international tax expert. There was a whole lot of those in here too, but really going to focus more on U.S. taxpayers, U.S. businesses, and cover some of the highlights. And we'll probably just take questions as
Well,
we go because I've got like a list of 13 things just to go through and
that's fine.
learn
Then
the specific changes.
then let's have
Maybe we do it that
Greg,
way. Yeah.
let's have at it.
Okay,
Okay.
couple things that
Yes.
did not change, pretty important just to focus on. Most people knew this, but no changes to the corporate tax rates, sub-C tax rates for C corporations, still at 21%. No changes to carried interest taxation, which a lot of people were worried about. That didn't make any of the cuts in either bill, so that's still status quo. To answer your specific question, Frank, nothing changed regarding gain exclusions on sale of principal residences. Nothing really changed in the capital gains tax rates on the individual side. So really not a whole lot of things other than what we've been doing in the past for those types of gains. So I'm gonna, I guess, start with maybe some of the business related things. And this applies to pretty much any business, whether you're a C Corp, partnership, S Corp. One of the big changes that we were expecting and hoping for is permanency to bonus depreciation. We had this starting back in 2017. It phased down to where for 2025, the current year, you could only expense 40% of personal property put in place. Now it's restored at 100%, and that's effective retroactively. Oh, that's the other thing. Every provision I talk about's got a different effective date. So this is going to be a full employment act for the attorneys and accountants. I can assure you of that. Most of the changes are kind of retroactive to January 20th, which coincidentally is the date Trump went into office. So unless I mention something different, you can probably assume the effective dates are January 20th of this year, 2025. So real summary, you can basically deduct any tangible personal property that you place in service up to 2.5 million. So it doesn't really help the huge companies because it phases out once you start putting in place more than 4 million of personal property. So by the time you get to like 6.5 million, there is no bonus depreciation. But for the vast majority of businesses, that allows immediate expensing. If there's any questions on any topic as I go, just feel free to shout out. We'll probably do it that way. Assuming no questions there. A related topic, there's a really hidden thing that a lot of people don't know about. In line with Trump trying to be so pro-US and anti-foreign manufacturing, they are allowing an immediate deduction, including for the value of real estate placed in service for manufacturing facilities in the U.S. That is a temporary thing. It basically goes through the end of 2029. If you are building a manufacturing facility and it's got to be producing tangible personal property, it's not going to work for like biomed or things that don't produce tangible personal property. Immediate deduction, and it really applies to anything where the contract was entered into after January of this year. There's going to be some transition rules. As long as you start it by the end of 29, it may allow you to still deduct that into 2030 as well. So that's a pretty big thing we've never had before. It even includes real estate, the value of the entire facility.
So just to clarify, Greg, you can deduct the entire facility over those 4 years?
Not the entire facility, the portion of the facility dedicated to manufacturing. So if you have like an office, an administrative that takes up 10%, you're going to be able to deduct like 90%. So there's still going to be a need for people to do like cost segregation and things of that nature to try to allocate. Again, a lot of this will come out in regulations and guidance because the law is so new, there isn't any specific detail. But as a simple example, there's no dollar limit on this too either. It's not like the bonus depreciation. So let's say you put in a $5 million facility. If 10% is allocated to things not related to the manufacturing floor or process, you get a $4.5 million deduction right up front when you place it in service. So that's something we've never had before, the ability to deduct any kind of real estate. I'm talking about 39-year assets, as opposed
And
to
you can write the whole thing off in year one.
Yep. And it is only the portion of the business related to the manufacturing itself. So more to come on that. One of the things that's, I think, pretty important regarding pass-through entities, so this doesn't apply to C corporations, but any partnership, any S corporation, we had a permanency of this so-called 199A deduction, which allowed business owners of partnerships and S corporations and certain specified businesses. It generally excludes consulting businesses, accounting firms, law firms. I don't know why, but we've not been a favored since 2017. But most of you who own any kind of business other than consulting or professional services businesses can get a deduction against your income of 20%. They kept it at 20%. In the House bill, they raised it to 23%. But it's now made permanent, so that effectively lowers the rate by 20% for a business owner in a partnership. There's really no change to the eligible taxpayers. We thought there might be some expansion of that to include things like professional services firms. Back in 2017, the lobby for architects and engineers must have been pretty good because they're allowed to get this deduction, but no other professional service providers are. There are some higher limits they put in. They doubled the limit where you could get this deduction before it starts phasing out over certain amounts of income and such. But in general, it's 20% off the effective tax rate, which we'll talk about when we get to some of the individual provisions. So that really was not unexpected. There was just some differences between the House and Senate on whether it be 20 or 23%. Didn't really expand the type of businesses. Another big one for US-based businesses, R&D, research and development. Anybody who followed this, a couple of years ago, they required all R&D expenses to be capitalized and amortized. They restored this as a permanent ability to deduct R&D expenses currently. Big change is that it's restored effective in 2025, but for a small business, which I think is actually one with up to like 31 million of revenue, they look at gross revenue, you can actually go back and pick up all your R&D expenses that were capitalized beginning in 2022. So 2022, 23, 24, you're going to be able to go back, and I believe it allows current year 2025 deduction for anything that's not been amortized. So they didn't make it truly retroactive where you have to go back and amend the prior returns. I think they're allowing the deduction to come into this year's return. So that's a big deal for any business involved in R&D. There's still the credit. They didn't really change the R&D credits, but this is a specific deduction that's favorable to research and development. Again, it's got to be US based only. This is another demand on the Trump administration. They're not going to allow R&D outside the U.S. to get this favorable treatment. It's going to be to stimulate U.S.-based R&D. Let me take a breath here. Business interests. There was a provision in the 2017 Act, the first Trump bill, where they only allow businesses to deduct interest to the extent of 30% of EBITDA. EBITDA is a concept anybody, in these businesses understands: earnings before interest, depreciation, taxes, and amortization. Well, that caught a lot of businesses that were heavily based on depreciation and manufacturing, where their interest was significantly limited and they had carry forwards. They've just basically changed the definition. It's still 30%, but they eliminated depreciation and amortization. So it's just EBIT, earnings before interest and taxes. You can deduct your interest up to 30% of that number as opposed to 30% of EBITDA. So it doesn't help a lot of businesses that aren't capital intensive, but a business that is, it's going to significantly increase the ability to get current interest deductions. Let's see, anything else? Let me look through business related. One of the big things that probably everybody's aware of by now, they more or less, and there's different phase out rules for every credit, but the whole energy credits that came in under Biden's Inflation Reduction Act, which has a pretty bad name for it, didn't really do anything to reduce inflation. But the only thing that was really kept in was these clean fuel energy credits. They extended that through 2029, but all of the other credits go away between September of this year. For example, the EV purchase credit for individuals is gone after September. If you're planning on buying an EV, do it in the next 2 months. Hydrogen credits, window and solar credits, most of those are gone between 2026 and 2027. You used to be able to, if you were a corporation, you could sell these credits. There was an aftermarket for these credits where a lot of people would sell them. You can still sell them, but in the interest of being very domestic, you can no longer get a benefit or sell them to non-US businesses. Foreigners cannot buy these things. Coal credits are gone after 2029. Minerals are gone after 2031 and 2032. Charging equipment, if you manufacture or install charging equipment, that's gone, but after June of next year. The residential credits for improvements on your home are gone at the end of this year. So again, if you're putting in windows, doors, or anything personal, you got to do it by the end of the year. Commercial home builder credits pretty much phase out between the end of this year and next June. This is just asinine and crazy. Why they couldn't have just one effective date, I don't know, but that's politics at its best. Manufacturing of facilities that are energy efficient, those credits go away as well. That's one of the ways they paid for some of this, is to eliminate a lot of these energy related credits. So anybody in that space needs to definitely get with their CPAs or attorneys to try to figure out the effects of those energy credits, because there's significant changes there. Most of the other provisions are either individual or relate to transactions, like gain provisions and things of that nature. So I'm going to stop there and ask if there's any questions on the corporate side in terms of corporate or business related transactions.
Or maybe Olga, you want to weigh in or you want to wait?
No, I mean, I wanted to talk about my favorite code section 1202.
Yep, we can go ahead and get to that now if you want to.
Yes.
Well-
So this is, I know somebody has a question.
Yeah, I had a question. You had mentioned hydrogen. I thought carbon capture and sequestration was still in there, particularly the 7 hydrogen hubs around the country.
I've only read some things talking about, I know some of the clean energy fuel credits are still in there till 2029. I don't know if it relates to that specifically. That's not one I've looked at directly, so can't answer the question specifically. They may or may not still be available, and if so, I don't think they're there past 2029.
Zarin has a question. Yeah, she had her hand up.
Yes. there was also something about gambling gains. Like normally you could offset your losses against your gains and be taxed on the gains. But now you can only offset 90% or something. Is this part of the corporate?
Olga can speak to
That's
this.
right. This is near and dear to me because my son files his tax return as a professional bettor. So basically, what happens is that, especially for people who do high frequency trading and betting, he does sports betting. So let's say, if you win 5.3 million and lose 5 million, you used to be able to deduct the entire 5 million of losses and pay tax only on 300,000 because you netted 300,000 for a year. Now, under the new law, you could only deduct 90% of the losses. If we take the extreme situation, let's say he wins 5 million and loses 5 million, so he got zero income for the year, he still will have to pay 10%.
Mm-hmm.
Yeah,
Yes.
that's an
Basically,
individual provision, and that's a great
yes,
example of tax policy at its worst. There's a very small
yes,
lobby
right,
of gamblers, so they didn't have any say so in that. So that was
yes.
you want to sneak in there as a small revenue raiser.
Yes, they snuck it in, and then I know that there's some, person from Vegas, I think it's a congresswoman, I'm not even sure who she is, but she's trying to change that, and I think she proposed Fair Bet Act, and there's some support for it, but it's actually kind of a strange provision, you know. Well, my son said it's going to destroy all professional gambling in the United States completely.
So
Yeah,
Zara,
I don't know if it will because we haven't been able to deduct expenses related to weed, and there's still a pretty thriving business there.
Yes. Yeah, well, my son said he's moving to Puerto Rico where there's no tax.
so Zara,
Well, if he
I
makes
didn't.
money, it won't matter that much, you know.
Yeah,
So
yes.
Zarin, I didn't know you were a gambler other than investing.
No,
Yes.
I'm not a gambler, but I'm fascinated by US taxes for no particular reason. And I was looking at the real estate version. There was a whole UBS report on it. I know lawyers are quite upset that they cannot be deducting now expenses compared to regular businesses. So there seems some parties that are upset.
Oh yeah.
Yes.
Yeah.
This
Gundan,
has some good and bad for everybody. I can pretty much say that as a blanket
You,
statement.
do you want to touch on that or any further on the services industry, Greg or Olga?
Well, so I think I wanted to say one thing is I feel like a big win for the lawyers, accountants, and financial services businesses. Everybody was worked up about the SALT deduction, right? Whether it's 10,000 or 40,000, but people don't really talk about it, that there's a SALT workaround for anybody who is a partner in a partnership. So, for example, I'm a partner at Winston Strawn. That means the partnership, my firm, can make an election to pay state taxes on my behalf. And I pay taxes in California, Illinois, New York, and probably every state, in the country because the firm does business in those states. So what happens is that, so let's say all my taxes in all of those states amount to, let's say 100,000, right? 100,000. So if I were to have them flow through to me on my tax return, the maximum I could deduct is 10,000 under current law. But under the SALT workaround, as long as my firm pays 100,000 and obviously deducts it from me, that gives me effect of 100% deduction of the entire 100,000. So, so far so good. The House version of the bill says, oh, we're going to cancel that workaround for financial services, accountants, lawyers, anybody who is in the service business. So, and then my partners send me messages saying, oh my God, what are we going to do? What are we going to do? I say, just, hang tight. Hopefully, it's not going to go through. And then, so in the final version of the big beautiful bill, that sort of prohibition on the workaround was removed. So I think all of my clients who are private equity funds, and myself in the partner setting, we're all fine. So any of you who are worried about this SALT workaround being gone, you could take a deep breath and say, no, it's still there.
Yeah, and I would agree that's a big win. Both the AICPA and the American Bar Association lobbied hard for that one. They did.
Yes.
They tried to kill the SALT workaround, and they were not successful. We can dive right into the SALT issues because that's a big one. That was a political football that got batted around for 2 months. There was like 8 versions of that before they finally settled. As people have read the headlines, they've increased, and this is really talking about at your individual level. If you have a pass-through business, like Olga's talking about, a partnership or an S corp, you absolutely, if you do any multi-state business or live in a high-tax state as an owner, you need to be looking at and do this SALT workarounds to be able to deduct it at the entity level. That's almost a no-brainer now. What they did, so really what I'm talking about now is at the individual level. And this doesn't, there's been a lot of misnomers that this $40,000 maximum is only for people in blue states. That's not true. I mean, I pay more than 10,000 of property taxes a year, even though I live in Texas and work in Texas and Florida. So this affects everybody. They have more than 10,000 of sales tax that you pay. That's part of the equation too. It's not just income tax that we're talking about. But one of the things that's a real trap here is this deduction of 40,000 phases out once your income reaches 500,000. So between 500,000 and 600,000, it basically goes back down to $10,000, which is what it's at, and becomes permanent in 2029, by the way. People don't realize it, but that incremental income between 500 and 600,000 gets taxed at about a 30% higher rate than income below 500,000. And if you're over 600,000 already and there's no way to keep it down below that, you're not going to get this $40,000 increase. You're only going to get the 10,000 that we've been stuck with since 2017. So we've got some real planning and timing issues for a lot of professionals and people that are in the $400 to $1 million a year bracket, that kind of thing. There's a lot of planning to be done there about bunching deductions, things like that. This really hurts people that do business through a Schedule C as an independent contractor, because they don't have the ability to do this SALT workaround at all. Of course, it has no effect on any C corporation. They can still deduct all their state income taxes at the C corporation level. So this was a big one. One of the things that is a planning opportunity that we're going to see a lot of people, and I've read a couple articles about this. We haven't really gotten to individual taxation, but one of the things this does not apply to is taxable trusts. As most of you know, you can have trusts that are what we call grantor trusts, where the income's taxed to the benefit the grantor who sets up the trust. That's commonly used in our estate planning. But now we're going to see a lot more benefit of people setting up multiple trusts for their kids, grandkids, and make them taxable trusts. There's no limit on the amount of state taxes that can be deducted by a taxable trust. So there's some planning that might be needing to be looked at there about the benefits of taxable trusts going forward. I'll talk more about that. Well, any questions about the state and local deduction? Because that one is kind of a quagmire and it's really hard to understand. But just keep in mind, if your income is going to be over 600,000 in any year, you're not going to get the benefit of the $40,000, and that's the takeaway, I'd say. Any questions there? Okay. One of the things that is interesting when we get into some of the individual provisions, of course, they lowered the top rate and made it permanent at 37%. I'm talking about the federal level, obviously, not the state level. Now we still got 14% plus rates in California and New York. So it's over a third of what the rate is in the states of what the federal rate is. So you obviously got to factor that in. But one of the things that's going to be favorable for taxable trust is just these income shifting opportunities to continue to tax things at lower brackets in taxable trusts. I mentioned the state and local savings. One of the things we'll get into, let's go ahead and dive into 1202 in a second. they changed. Let me save that for a little bit. You can also get more of these pass-through deductions if trusts or owners in operating businesses that qualify for that 20% Section 199A deduction I was talking about earlier. I think you're going to see more interest in state type trust planning, what we call NINGs, DINGs, WINGs, Nevada, Wyoming, Delaware trust, things of that nature to avoid state taxes at the trust level. Go ahead.
Andrew.
Yes, Andrew.
Hey, Greg, sorry to interrupt. I have a quick question. What are the changes for non-grantor trusts? Could you go? I'm sorry. I think you might have just jumped over that.
There
How does that change?
really aren't. Yeah, there's no changes to them. It's just because they didn't put any changes that would limit their state and local deductions. We don't have any kind of $40,000 or $10,000 cap. So the taxable trusts have unlimited state income tax deductions. And there'll be some income shifting, you know, where people are in the 37% bracket where they want to put it into lower level taxable trusts that are below that bracket. So there'll be some federal tax savings too, I think, with using taxable trusts. It just makes them, I think the preliminary things I've read is will make them much more attractive going forward to consider.
Isn't there a minimum tax on a non-grantor trust?
Well, it's basically the same individual brackets that you have for individuals. So if you can keep the income at a lower level and set up multiple trusts, you're going to have a lower overall income tax liability. Instead of you being taxed at 37%, you might be able to set up 5 trusts for kids and grandkids taxed at 20%.
Got it.
That's
Cool.
a simple example.
Thank you. That's great. Appreciate it.
You want to start with some of the highlights in 1202, Olga? Because I've got a couple of notes on that too, but that's a big one for anybody that's
Yes.
setting up a new business or looking to potentially sell or exit 3 to 5 years from now. And I'll just
Yes, yes. So, Code Section 1202, I think some of you are really familiar with it and some of you are not. So basically what it says is that if you, a person or a LP or GP in the fund through a pass-through entity, buy shares of the company that is a qualified small business stock, and the law used to be that it had to be a C corporation that has less than 50 million of assets at the time you bought into the company. And if you hold that stock for more than 5 years, then when you sell it, you get to exclude 10 million per company per person. So if you think about it, the whole point is to encourage, startup activity. So if you have 3 founders who set up the company that's in the business of, I don't know, something, roofing, right? And then they sold this company for 30 million 5 years from now, then they would pay no tax. No federal tax, no state tax, unless they live in California or Pennsylvania. Those are the only 2 states that don't follow the rule. Is there a question? Do we have a question? Somebody has a hand up.
Michael.
Yes. So, my understanding, and I've got one company that just exited where I've gotten the statement that they qualify for Section 1202.
Yes.
And I have another one where I'm well in terms of the value of my shares is well into 7 figures. So my understanding is it's not just a $10 million limit. It is 10 times your investment.
Right.
Or
It's a great-
10 million,
yeah.
whichever is less.
Right.
Correct. That is correct.
Yeah. So if you put in more than $1 million, it's going to be more than 10 million. As long as the overall assets of the company weren't more than 50 million and it's gross assets, it's not net assets.
Right.
That's what the current law is up until July the 4th, the
Yes.
effective date of this law. And that's what a lot of people haven't recognized. These new changes that Olga was about to talk about are only for investments made into a qualifying business after the effective date, which is July 4th, I believe. So
That's correct.
if you're going to convert, say, and we'll get into the specifics about why this is something that needs to be looked at for anybody that's got any kind of venture capital or seed investments, angel investments. There's definitely some specific reasons to look hard as to whether you're better off being a C corporation. If it's not a C corporation now, I think, and I'm still trying to confirm this, but I'm pretty sure the law has always been the case, and I think it's still the case, that you cannot convert an S corporation to a C corporation because it's the initial issuance of the shares of the corporation. So if you already have S corp shares, you're not going to be able to convert it. Partnerships, you can. We've done several partnership conversions.
Yes, you can do an S corp, but not through a conversion. You have to do an F reorg, basically.
Yep.
So
Yeah.
I have another question
Yeah.
because one of the companies I've invested in, I invested in their very first round, and now they're doing an A round. And so that's not going to close until the end of the month. So I'm going to have to calculate it two ways, is what I'm understanding from what you're saying. The investment before the fourth falls under the old, and then the investment after the fourth would fall under the new, correct?
Yes.
Right.
And this is a C corporation, I assume, that you're investing in?
Yes.
Yes, it's got to be a C corporation in a specified business. They didn't change the definition of what is an eligible business. That's one place that I think us accountants and lawyers got screwed. The same, it really piggyback deductions for pass-through businesses. But if you're in a professional services or consulting business, it generally does not qualify for this treatment. So you got to look at the definition of what's eligible business too. And there's only a handful of this law has been in the code in various forms or fashions for almost 25 years, but it never became of great utility until about 2017 when they liberalized the rules for the first time. So there's a handful of private letter rulings out there about what's eligible and what isn't. So there's still a lot of gray on which businesses are eligible. So word of warning, get your advice from your tax advisors. And I'm kind of surprised, whoever said that they sent out a notice that you're eligible for 1202. Most companies will not even tell you whether you're eligible. They leave it to the individual owner because it's at the individual level where it applies. So very
Well,
few.
no, this was after the exit.
Yeah, but they usually don't even tell you whether it's eligible or not. They leave it to the advisors for the individual shareholders, is what I've seen. It's rare that they would tell you it's eligible, is my experience. There's nothing requiring the company to tell you if you're eligible or not.
Yeah, so I mean, I work with a lot of venture capital and private equity funds, so they like to give their LPs information. They say, we exited this portfolio company. It is possible that it is 1202 eligible. Please, discuss with your
Consult your
tax
tax
advisor.
advisor. Yeah,
Yes. So, but
that's
it's
what I
like
see.
the fund CFO typically will send with the K1s a note saying that, this company could be eligible. I think it's sort of people like to, tell their LPs good news. But, without saying that, yes, it
Right.
is
They,
1202.
they try to make you aware of it at least so people don't
Yes.
blow it or forget it. But most of them kind
Yes.
of hedge their bets and say it may be eligible. I think that's what I've seen more than anything.
Yes. So, okay, let me just go over what changed. So the final bill, there are three changes to 1202. First, the bill increases aggregate gross asset threshold for a corporation to be treated as QSB from 50 million to 75 million. And we're talking at issuance. Even if the company has a $5 billion IPO, you could still qualify, as long as at the time when you made the investment, it had less than now 75 million of assets at issuance. And then the point that we discussed, the 10,000 actual, so like, let's see, so it's like 50 million. Okay. So in terms of how much you get to exclude, so the applicable dollar limit in respect of the gain that we discussed is going to be increased from 10 million to 15 million, which is great news for the investors. And that amount would be adjusted for inflation in 10,000 increments for taxable years beginning after 2026. So that's definitely a positive improvement. And then I feel like the biggest improvement that they have made, now it's sort of like almost like a cliff eligibility. You either get to 5 years or you don't get to 5 years. And then you get to, have the exclusion or you don't. But now what the new law says that if you held the stock for more than 3 years, you get to exclude 50% of your gain. And if you held it for more than 4 years, you get to exclude 75% of your gain. So it's it's sort of and then again, if you got to the 5 years, that's 100% exclusion. So I think that's a great benefit for the GPs who sometimes, want to exit from the portfolio company, but they didn't get to the 5 years, and it's sort of they get just a regular capital gain, and the LPs as well. So I think this is the great benefit. So, but so those are the benefits, and then I think that's kind of the biggest improvement in my mind in terms of the exits for the VC funds and private equity funds.
Yeah, I agree. This is the biggest thing, and I don't think many people saw this coming, that it's so favorable for the early stage companies, even through kind of A and B rounds. Any investors in those funds, definitely the funds need to be and the businesses, I guess, need to be looking at their structure and whether this is even more advantageous. Particularly, I know at least Frank, one person on the call that's maybe looking at an exit in 3 to 5 years after converting to C. And the other thing I think that's maybe a negative here that people don't realize, and I haven't verified this myself, but I heard on a webcast yesterday, if you have that 50% gain exclusion and you hold it 3 years, it's at the 28% rate, not the 20% capital gains rate. So I think you're looking at a 3 or 4 year hold as having an effective rate of either what would that be, 7% or 14%. You're still going to have a rate, but there's a partial exclusion of significant amounts of gain, up to 15 million instead of 10. The other thing that's really powerful here, which I don't think people have focused on, this goes back to where we use a lot of different trusts, taxable trusts, for the benefit of families. If you set up a trust for 4 kids and another one for 10 grandkids, now you've got 14, 15, 16 different owners that can each get a $15 million exclusion. That's incredibly powerful. You can get up, over 100 million of gain exclusion pretty quickly if you want to take advantage of what we call stacking, because each trust that's a taxpayer is eligible as an individual shareholder. Again, they've each got to meet that 5 year holding period for the full gain exclusion, but 15 million per trust times however many kids or grandkids or other people you've got in your family is pretty powerful. So that's another planning strategy I think that's going to get a lot of attention here going forward. Sorry to spend so long on one topic. I think that's really
Yeah, but it's a good one.
But I think it's really relevant for this group because we have so many people that are VCs or invest in early stage companies. This is definitely worth a look-see. It doesn't get much lower than a 0% tax rate, as I like to
Yes.
say.
Yes.
It's on an exit. While we're talking about kind of individual planning, there's a couple of things that, again, it's kind of like watching sausage being made. They limited the benefit of your overall itemized deductions to 35%, even though the top tax rate is 37%. You can't offset effectively dollar for dollar your overall itemized deductions. So it's a slight increase among the wealthy, and it's generally taxpayers well over 600,000 of income that this is going to apply to. They did away with these phase outs, so-called piece limitations, where you could lose up to 2 or 3% of your itemized deductions, but instead they limited the overall benefit to 35% of your taxable income. And they put in a floor for charitable deductions where the first 0.5% of your deductions, 0.5% of your income. So let's say your income's $1 million, just to make it simple. That would mean the first 5,000 of charitable deductions you get zero benefit for. That was a small revenue raiser they tucked in there. Obviously, the more you make, the more that's going to affect you in terms of your charitable giving. It's basically a haircut for charitable deductions, which a lot of people haven't focused on yet. I'll leave out some of the political things that were strictly campaign promises. Probably doesn't affect too many people here. The exclusion or deductions, I guess you'd say, they were deductions they put in for tip income, overtime pay. It only affects people making less than certain amounts. The amounts are capped at $25,000 deduction for tip income, $12,500 for overtime pay, $25,000 for married couple. Those go away after a few years, after about 3 or 4 years. The same thing with a deduction for seniors they put in there because they were talking about not touching Medicaid or Medicare. Well, that was the political football that they ended up making some pretty drastic Medicaid cuts. So they're giving seniors up to a $6,000 deduction, but again, it phases out for seniors that make a decent amount of money. The car loan thing, they promised that in the campaign, so you can deduct up to 10,000 of interest on car loans. Those are kind of the highlights of some individual things, but they really don't benefit really much high income people. The big one that I focus on heavily, because I do a ton of estate planning, I think we've got finally some absolute certainty for the first time in a long time, where they right now, as most people are aware, we have an estate and a gift exemption of 14 million per person, about 28 million per couple. Beginning next year, it's set permanently at 15 million per person, 30 million per married couple. Pretty significant, and it's indexed for inflation, so it just goes up automatically. I don't expect there to be a lot of tinkering with this over the next few years. So I think we're going to see a huge renewed interest in people that owns business interests, certainly families north of 30 million using trusts and all kinds of trusts, taxable trusts, non-taxable trusts, installment sales. They didn't touch any of our favorite techniques that we've been using for 20 and 30 years. There was a lot of rhetoric, particularly from the Democrats, about putting in, billionaire taxes and 100-millionaire taxes. They didn't pass any of that. They didn't do away with discount planning, which is still our best friend. They didn't do away with grats. They didn't do away with some of the techniques that we've been using. Like I said, I think there's more incentive than ever to do significant estate planning and get business assets into long-term generation skipping trusts. I think you'll see a lot more interest in using life insurance inside of trust now. There's going to be some favorable ability to take advantage of these basically 30 million per couple, 15 million per person exemptions. Everybody who's north of that level ought to be using those while they're alive, not wait until you're dead. That's basically the message there. So I think we'll have a full employment act for doing estate planning going forward as well. One thing on that 1202, no, I guess I did mention that. I mentioned the stacking on the 1202, so I think that's another benefit of using trusts that we talked about. What did we leave out? Opportunity zones, I know we haven't talked about. I'm trying to see if there's anything else. And I haven't gotten into all the nitty gritty.
Oh.
Yeah, go ahead. Let's take any questions.
I was just gonna say, just take some questions.
Yeah, that's all the highlights I was going to cover for individuals, basically.
Rich, did you have a question?
No, I did not. Let me mute myself.
No.
Yeah, so I think that's pretty much it. I mean, in terms of I know we're not covering international, right? But
Well,
if you
why don't we
have
touch
any
on that?
highlights, go ahead, because that's just not an area I've explored.
no, it just because I had a lot of clients were really concerned about code section 899. So the good news is that 899 is not in the, in the big beautiful bill anymore. So, so basically that was retaliation against unfair foreign taxes, because the original House bill had a new section which would have permitted increases to statutory rates to certain income, withholding, and excise tax. That would be applicable to residents of discriminatory foreign countries that are deemed to have imposed unfair foreign taxes on U.S. persons. And then so there was a tentative agreement reached with the G7 not to impose taxes on U.S. company, so that that proposal was not included in the big beautiful bill. Somebody has a question?
Samir?
Yes. So, didn't know if you guys talked about this already, but QSBS, right? So qualified small business stock. So Greg,
We
getting
did. We did.
That's
Yes,
we're calling it 1202.
There's a recording, Samir, but if you have a
Yes.
very specific question, you
Yeah,
maybe
sorry, some of us tax geeks refer to code sections, but it's
Yes,
known as
1202
it's known
QSB.
as 1202 stock or qualified small business stock.
Yeah, so you could click on my client alert that's in the chat, and it's all covered in there. So somebody asked, what about stock options that I issued for C Corp and held for more than 5 years and exercised shortly prior to exit? Nope, sorry, cannot have.
Got to be the stock. I've had that question many times.
Yes,
You've got options. The 5-year period doesn't start till you exercise. And that's for
correct.
any option, whether it's qualified or non-qualified. A lot of
Yes.
people thought that the 5-year hold started when you had the options granted. Not the case. So that's
Yeah, same with convertible debt. People say, actually, somebody says, one of the tax advisors told me that convertible debt qualifies as stock. I'm like, well, I don't know who that is.
no.
Not anybody I would work with.
Yeah, exactly. No,
So,
that's
but interestingly, if you have a safe note for those in the VC community, safe notes typically state in the document that for tax purposes, safe note will be treated as equity and therefore as stock. So that's, one thing to keep in
oh,
mind.
that's interesting. I have that issue right now, so I'm glad you mentioned that.
Yes, yes, safe note. Yep. If you're working on
Oh,
one, make sure to
oh,
stick that
Olga,
language in there.
But again, it's
what's
got to be a safe where the company's structured as a C corporation for it to work.
Correct, correct.
can you
Yep.
can you restate that, Olga?
So whenever you have, it says, for qualified small business stock, what is stock, right? Somebody asked, is the option stock? The answer is no. You will be treated as acquiring stock when you exercise the option. Second, somebody asked me, is convertible note qualifies as stock for purposes of holding period? So let's say you have a convertible note for, shares of the company that you invested in. So the answer is no. You don't get stock until you convert the convertible note and you start your clock for the 5-year or 3-year or 4-year, right? So another question is the note that's called safe note? I think it's called simple agreement for future equity. That's the VC kind of a, lingo, safe notes. So what is that? So typically a safe note will say in the body of the instrument, this security will be treated for tax purposes as equity. So people take a position that whenever somebody makes an investment in a safe note, actually I have, I'm telling you from personal experience, it says it there, it says you will be treated as equity holder in the company from the date that you acquire that safe note. So even though it's called simple agreement for future equity,
Yeah,
right?
these things are strange animals, and they
Yes.
also are for GAAP accounting. They're neither debt nor equity. They sit on the balance sheet kind of between the two, and they're
Yes.
convertible into shares, generally at a transaction or when an investment comes in the future. And they say for future equity. So I'm anxious to see what would you say if the safe note is silent? Because that's usually what I see. Can you still take that
I think
position?
it just depends what the company, what position they're taking, but the company doesn't need to take this position on any tax return,
They don't
right?
take this, right? It's
Yes.
up to the individual. I think you
So
could, but
I think you could, you could take a
oh,
position that
the only
this
thing I don't
equity.
like about it is called future equity. That's what it says
Yeah,
in
I
the
know,
title.
I know, I know. Yes, yep, yep, yep. So
Hey, there's
anyways,
no downside to taking that position, is what I would argue.
yes,
And it's
exactly.
Any other
never been
questions?
addressed. It's never been addressed by the IRS, and safe notes are very common. I know of several raises you're doing, Mark, where they're using safe notes. So this is pretty relevant for that too.
Yeah, so I think, for the international stuff, the 899 elimination is a big deal. People were really worried about it. They were forming all kinds of like groups as to discuss what impact it will have for, non-US investors and US funds, but it's gone and then it's great.
Yeah.
So and then and I guess the fun fact, since we were supposed to reduce our debt, the original House bill would have increased the debt ceiling by 4 trillion. The final bill goes further and it proposes an increase of 5 trillion. So we didn't reduce anything. We actually increased it.
Yeah, a lot of politics behind that number too. But
Mm.
the last thing I want to mention, because I know we're running short on time, opportunity zones. that we actually thought there might be some more favorable things that didn't make it into the bill, such as enhancing some of the benefits and things of that nature. What actually passed, and this was kind of a mishmash between the House and the original Senate, they put in, and this was kind of a last minute change, they put in what they're calling a series of rolling 10-year opportunity zones, but they don't start till the year 2027. The reason this is important, if somebody thought they were going to sell their business and invest in an opportunity zone to get a deferral, the same rules apply as are in place today through 2026. Well, if you go back to 2017, the maximum deferral would have ended in 2026. So if you sell this year or even next year, you're going to get 1 year or less of deferral. These new rules kick in 2027. They've tightened down the definitions of what's going to be an eligible opportunity zone. I think they saw too much getting let out of the barn that was eligible. Every state, like I think the entire state of, maybe not the entire state, but the entire city of Portland was an opportunity zone, for example. And they left it to the states to determine the opportunity zone. So there's going to be a tightening of the definition. And this is strictly a deferral. And if you hold the investment long enough, meaning 10 years, there can be some permanent elimination of gain. But the thing I've found about opportunity zones that most people don't get comfortable with, if you sell your operating business that you've had for 20 years and you know that industry, you got to invest 100% of your proceeds with somebody you don't know, in a business you don't understand, in a jurisdiction you don't know, and put all your eggs in that basket just to get the tax deferral and or elimination. I personally believe there's a lot better planning strategies we have and that I've used where people can monetize and liquidate and invest in whatever they want. Opportunity zones have their place, no question about that, particularly if you're in real estate and understand the industry. But you know, you got to invest in a business. So it's an investment decision, I say, more than a tax decision. But I think if you're planning on selling a business and using opportunity zones anytime in the next 18 months, there's going to be some deferral strategies like using installment sales or deferring the gain till 2027. Things of that nature are going to become more important because the current law is still in place till the end of 2026. And we quit using them about 3 years ago because the deferral wasn't that great when you're only talking about a deferral into 2026. So I think it's even less attractive for somebody right now to invest in an opportunity zone. It will become attractive again in 2027 is at least what I'm reading and hearing. Yeah, there's a question, I think, Michael.
Yeah.
Michael.
Any changes on recapture of depreciation is ordinary income?
No,
Okay.
at least not that I've read. No, I haven't heard anything about that changing at all.
Just checking.
And that's a good point because now when we have this bonus depreciation and we have the deduction for the manufacturing, they'll still be recapture to consider when you sell those properties down the road. It's just accelerating your deductions. And possibly, I hadn't even looked at that yet, but like for the manufacturing, if you deduct that immediately, I'm curious whether there'll be recapture on that entire amount, probably when you sell it. So that's just an acceleration. Both of those depreciation, any depreciation is just an acceleration. You've got to be cognizant of on the flip side when you sell, whether it's going to trigger ordinary income or capital gains. That's basically the nature of his question, which is a great one. And I don't know the effects of recapture on the manufacturing deduction they put in. That's a great question.
Andy?
Yeah, question again about opportunity zones. There was talk before the bill was passed that they would broaden the type of revenue available before it had to be very central to the opportunity zone in which the project was. That's why real estate was, the predominance of projects were real estate.
Right.
Did they broaden that definition in the end?
I don't think so. Don't hold me to that. I read some early drafts from the House and others where they proposed not just broadening the definition, but they were going to allow fund-of-fund investments where you can invest in a fund that might invest in, say, 5 different projects that qualify to diversify. Because one of the problems with opportunity zones, like I said, is you're kind of putting all your eggs in one basket that you don't really know. To qualify, you got to invest it in a business, a single business, in a jurisdiction you may not know anything about. And so they were trying to allow people to create kind of a fund of funds where they can invest in multiple businesses, where you can perceive there's less risk, right? Because you're diversifying amongst different businesses. I don't think any of that made it into this legislation. I think all they did was threw in this last minute thing with this rolling 10-year investment horizon. So there'll be a 2027 vintage, a 2028 vintage, 2029. And I don't know for sure, but I think it's a permanent type of thing that goes on, but not till 2027. And of course, that's subject to change again if we get a new administration before we get to 2027. So,
Okay, thank you.
yeah, that's a great question. I don't know the answer to that one, but I'm pretty sure none of that you're talking about made it in there. I was following that a while ago and kind of gave up when the House and Senate kept fighting over things.
There was a lot of optimism
Yeah,
around
there was.
opportunity
There was.
zones.
No, I was
2 3
optimistic because I have a lot of clients that have OZs or tried to form them, and they were just so hard to sell because, like I said, people forget about the economics or the investment side of things. Like 1031 exchanges. If you're in the real estate business, you're comfortable with 1031 because you know the industry. If you've got a building and you don't know much about the industry, do you really want to put all your eggs into real estate again in another jurisdiction or something you don't control? So, it's one of the tricks in the toolbox. 1031's been there since the 50s, but it's not for everybody. It's just a deferral strategy too. Just like these OZ things are, they're deferrals, but although if you hold it a long time, meaning 10 years or more, you can get permanent gain exclusion on the upside, not on the gain that you're exiting, but from that point forward. So that's pretty attractive. But I remember when they first came out in 2017, people were like touting investments in Puerto Rico because they, designated the whole jurisdiction as an opportunity zone. Well, do you really want to invest all your money from a sale in a business in Puerto Rico you know nothing about and don't know the owners, who's running it? So anyway, there's a lot of, I think, more talk about it than there is about people using OZs.
Thank you.
Great question, though. Thank you, Andrew. Mark, I think we hit the hour. I didn't think we'd go that long.
We did, but I was gonna comment. You think every question is great, Greg.
Well, they are. I love taxes. I mean, I'm weird.
I know. No, we did it. We did an hour update. I appreciate you and Olga for making yourselves available. You may want to put your contact details in the chat, or you may regret it. Either way. Appreciate everyone joining
Anytime.
us. We will be
Anytime.
talking about taxes in Newport on July 20. Come join us. Looks like we're gonna have a full house. In fact, we might even move to another house. We'll see.
Oh, you have any update on that? I was just wondering. You talked about that, I guess.
Talked to him yesterday. I'm gonna talk to him today again, but it's just it's intriguing to move it over there to this beautiful mansion that's been offered to us. So we'll see. But yeah, that we'll continue this discussion. I'm sure there'll be more nuances to be had. But just wanted to make sure we got an update. We didn't know if there was going to be passage, and then there was, and here we are. So here we go. Well, thank you everyone again, and we'll see you next Tuesday. We're focusing on AI. Our deep dive after the briefing is on a 3-part series on sort of practical AI. Talk to you then.
Alrighty.
Thanks, everybody.
Sounds good.
Later.
Bye-bye.
Bye, everyone. Bye-bye.
Everyone. All right. Team, I'll be right back.